Good morning, everyone. This is Jody Tate of the DCIS Training Department. Thank you for joining us for today's webinar on prevented planting. All right, with those details out of the way, I'm going to go ahead and turn this over to Tom.
Thank you, Jody. And I want to just welcome everybody that's attending today. We actually got some seating in our office that I believe we have one conference room here that's fairly full. I can say one thing. I wish we were not having this webinar today. No offense to any of you at the Diversified Crop Insurance putting this on. It's just that I would rather have a situation where we wouldn't have to do this webinar today. But we have had some favorable planting conditions in the last week or so. Right now it's kind of at a standstill again, but in the next week and a half or so, we're going to have some of our farmers that will have to make some decisions, and today's webinar is to help educate them on the options and for them to make those decisions. So right now we're going to switch it over to our presenters, who is Janice Thorp, who is a Technical Training Specialist at Diversified Crop Insurance Services, and Brad Guthrie, Claims Training Manager and Technical Support at Diversified Crop Insurance Services. So without any further ado, please take it away.
Thank you, Tom. This is Janice Thorp. I am pleased to have the opportunity to present the prevented planting information to you and your customers there in Minnesota and Iowa. I am pleased also to say that Brad Guthrie is joining me to assist in answering the technical questions and also to give any feedback from his experience working in the claims department. To begin with, I wanted to just point out a disclaimer. We do believe all of this information is accurate and reliable. However, it is subject to change, and one should always refer to the policy language and procedures to verify the information. Each prevented planting situation is unique, and not all scenarios will be covered today. Make sure to contact the DCIS claims or underwriting departments for specific scenarios. In your situation as producer/insureds, policyholders, you would actually reach out to Tom or one of his staff members with questions, and he would then reach out to the claims and underwriting departments for you. The resources that were used to develop this material was the Common Crop Insurance Policy. The Common Crop Insurance Policy is the policy language that is in effect for your revenue protection with harvest price exclusion, or yield protection policies. We've used the Loss Adjustment Manual Standards Handbook and the Prevented Planting Standard Handbook for the current crop year as well. These are all documents that come from the Risk Management Agency that pertain to your crop insurance policy. So to begin with, we have an overview of Prevent Plant. What is prevent planting? It is the failure to plant the insured crop. It must be due to an insured cause of loss that is general to the surrounding area and prevents other producers from planting acreage with similar characteristics. Now, I will caution you, there could be a rare instance where one producer in an area is prevented from planting their crop when others in the area are not. These do get looked at on a case-by-case basis to confirm if it truly is a prevent plant situation. So basically, you do not want to decide not to turn in a prevent plant claim just because no one else in your area has turned one in. Leave that up to the Diversified Crop Insurance staff to determine if it truly is or is not a situation for prevent plant. In other words, always turn in the claim. Let us decide if it's not applicable. So for area, I mentioned that the prevent plant situation must be common to the area. This can get confusing for some of us because we think, oh, area means our neighbors right around our farm, land that touches us or within a few miles of it. That is not what the RMA risk management agency classifies as an area. The area is acreage with similar characteristics, including land with comparable geography, topography, soil types, and the same weather conditions and exposure. Ownership of the acreage, or whether it is insured, is not to be considered when we determined if acreage has a similar characteristic. So in other words, you may have a field that in your particular location is a little lower than the surrounding area. Maybe it's a little closer to a creek or a river or some other geographical situation, and there's something similar. It might even be in another county, that we're looking for the similarities in the land and the weather pattern, not what particularly happened to your neighbors. When must the insured be prevented from planting? By the final plant date that is listed in your special provisions for your particular crop and county. Now, the special provisions is language that was provided to you with your crop policy paperwork when you applied for your insurance or for your carryover policy for the current year. It can be prevented also within the applicable late planting period if you have a late planting period as well. So for your reference here, I researched and pulled up the counties from Americana and found the plant dates, and have the final plant date and the end of the late plant period here for you. If you are in Iowa, for corn, the final plant date is May 31st, and the end of the late plant period is June 25th. For soybeans, it's June 15th, and the end of the late plant period is July 10th. For the Minnesota counties, corn is May 31st with a June 25th final plant date, or end of late plant period, I'm sorry. Soybeans has a final plant date of June 10th. It's 5 days earlier than Iowa. And the end of the late plant period is July 5th. Now, the reason we're mentioning these is the insured could be prevented from planting all the way, let's use corn for an example, all the way to May 31st. At May 31st, the final plant date, so on June 1, you could elect to not attempt to plant during the late plant period and turn in a prevent plant claim or prevent plant notice of loss. If you choose, you can continue to plant during the late plant period. That is an option. Or at any time during that late plant period, if you decide, let's just say on June 10th, you decide you're not going to continue to try to plant that crop in some of your fields, you can at that point turn in a notice of loss for prevent plant on your acres that are not planted to that point. I also did include here on the bottom of the slide that for the Minnesota counties insuring barley or wheat, and this is spring wheat, the final plant date for those was May 15th, and the end of the late plant period is June 9th. So if you did not get one of those two crops in, you still have time. If you did not turn in a prevent plant on that notice of loss, you can still do so all the way up until June 9th. Failure to plant due to an uninsured cause. These include the lack of proper equipment, labor to plant the acreage, or use of a particular production method is not considered prevent planting. So for example, if your equipment breaks down and because of a breakdown of equipment you cannot finish planting your field, you cannot turn in those acres for prevent plant if weather conditions allow for planting. If you do not have the labor to finish, for example, it's been very wet in your area, you have not had a chance to get out into all of your fields at this point, you do not have enough labor maybe to plant everything that needs to be planted. Not having enough labor if the days are available to plant is not a reason for being prevented from planting and is not something that a payment can be made for against a claim. You may receive a prevent plant payment for eligible PP acres if the insured was prevented from planting the insured crop due to an insured peril occurring during the prevent plant insurance period, if all other prevent plant provisions are met. So there are some additional conditions that have to be met that we'll talk about during this webinar. The insured may be eligible for a prevent plant payment if by the final planting date or during the late plant period, the insured is prevented from planting on insurable acreage. If there is more than one final plant date in the county for barley, oats, or wheat, the applicable final plant date is the latest final plant date. Covered causes of loss. These must be due to an insurable cause of loss. These are listed as excessive moisture, precipitation, and rain. Additionally, we have some other items that are covered, such as flooding. I'm not sure if flooding is a concern for your area. I know Minnesota has a lot of lakes. I'm not sure about the rivers and such. But if you cannot plant due to large amounts of salt, silt, sand, or other debris left behind on the land or in your irrigation water supply, that is also insurable. The inability to access roads to a field is an insurable prevent plant cause. Now, this means you have no access to your particular field, not that you would have to drive out of the way to get to your field. If you have some access to that field, you do need to make the attempt to get there. Drought is also a concern, but we're not going to talk about that one today because I don't believe that's the current issue. So for the criteria for prevent plant payments, the policyholder may not plant the insured crop claimed as prevent plant during or after that crop's late plant period. If you do plant this crop, it is considered to be late planted and not considered to be a prevented plant. There are situations when you can plant another crop on that land, and we're going to discuss those as well. But just be careful to know you may not plant the same crops on that same acreage. No requirement exists to plant during the late plant period, even if you can plant during that time. So once we've reached the final plant date and are entering into the late plant period, it's up to you to determine, do you want to continue to plant that crop, or do you want to turn in a prevent plant notice of loss for the particular acreage that you have not reached. Now this is not an all or nothing kind of a thing. You can choose to plant or to try to plant some of your fields during the late plant period and turn in prevent plant on others. It's not required that you make a decision for all your fields at one time. Again, I would, you can decide to change your mind and decide not to plant during the late plant period, all the way up till the end of that late plant period. On a side note, we're going to get a little bit off topic for the second, but we're going to get back on it. What happens if the producer still wants to plant corn during the late plant period? Assuming Assuming the insured has been prevented from planting up until the late planting period has begun, so that's the first thing. Again, the insured may attempt to plant, but it is not required. Now, if you do elect to plant during the late plant period, your production guarantee is impacted. For the common crop insurance policies, as I said, which is your revenue protection with harvest price exclusion, and yield protection policies. These crops have late plant periods. Corn and soybeans do have a late plant period. what will happen is if the ground is planted during the late plant period, for every day late it is planted, those acres receive a 1% reduction in the guarantee. So an example here is a soybean example. The production guarantee per acre is 40 bushels, and the insured elected prevent plant plus 5%, so the PF election, for a total of 65, oh, I'm sorry, I apologize. I'm reading this slide. I'm off topic just a little bit. So the late plant period is 25% guarantee. Backing up just one quick second, I advanced too quickly. The crops planted in the late plant period will get the 1% per day reduction in their guarantee. So if you plant 5 days late into the late plant period, then those particular acres will have a 5% reduction in the guarantee. So whatever, the simplest way to think about this is whatever your indemnity would be on that particular policy for those fields that are planted late, you would get 95% of it. We would reduce it by 5%. Now to this slide, sorry. Acreage planted after the late plant period are reduced by multiplying the production guarantee by the PP percentage on the policy. So for example, here is the soybeans. The production guarantee per acre is 40 bushels. The insured had the PP plus 5%. The normal prevent plant for soybeans is a 60% coverage. With the extra 5%, we now have 65%. The production guarantee for that particular unit would be 26 bushels for the late plant guarantee. How we determine this is we take the bushel guarantee per acre of 40 times the 65% PP coverage level the insured has to get that number of 26. So for this particular unit, the insured must produce less than 26 bushels per acre to receive an indemnity. Now, to insure the acreage planted after the late planting period, the acreage must have been prevented from being planted during the entire late plant period. This is an option. You do not have to insure the acres after the late planting period. That's a choice the insured can make. The only time they can, however, insure it is if it was prevented during that late plant period. So now we're going back to the prevent plant topics again. PP coverage level percentages by crop. This information you can find in the actuarial information browser. This is on the RMA website, the www.rma.usda.gov. If you need assistance looking up this information, I'm sure that Tom or someone at his office would be glad to assist you in looking up the actuarial information for your particular region. And if you can see here on the slide, we do have an example here for the corn crop. This is from Illinois. It's just an illustration here. But the prevented planting coverage level tab will show for that region what the level is. So here for corn, we have a 55% prevent plant coverage, and then also letting you know that the PF prevented planting plus 5 is available in your particular area. Additional information on PP coverage levels. You do have to purchase a policy above the catastrophic level or the CAT level to purchase the prevent plant plus 5. This is done on or before sales closing date. The actuarials, as I just showed you, will indicate if it is available to you for an option. And you cannot increase this if a cause of loss exists that could prevent the crop from being planted. So at sales closing time, if you already have an existing cause of loss, the company, the RMA, does not allow you to purchase a higher level for your prevent plant. Pricing that is used. This is a common question that will impact your decisions. The price that is used is a projected price. The projected price is the price that came out in the springtime. So for this year, for corn, it's $3.96, and for soybeans, it's $10.16. Easy way to remember this is that the projected price and the prevent plant both have the letters PP as a code for them. Now, the harvest price is not used for this part of a claim, so the insured, you will not be charged for use of the harvest price on this particular any ground covered on a prevent plant claim, because you do not get charged for something that is not being used by you on your policy. So the premium for prevent plant is the same as for timely planted acreage, with the exception of if you elect to plant another crop other than the one that was prevented from being planted on the acreage. If that's the situation, we do have a situation where we will reduce the premium on the prevent plant acres. This is done down to 35%. I'll cover this. We'll talk about the reasons and how we reduce the premium and reduce the information when another crop is elected to be planted for that area. Your insurance coverage will end for the prevent plant the earlier of the calendar date for the end of insurance. So that's published in your policy. The end of insurance is later on in this year, towards the end of the year, or the date the claim is finalized for the prevent plant crop acres. So obviously, if we finalize the claim, we're not going to continue to put coverage on that particular acres because there's nothing more to insure. So this is important to pay attention to. Eligible acres for prevented planting must be insurable, available for planting, meaning it's free of trees, rocky outcroppings, cattails, etc. That the land has to be, something that you would normally be cropping or planting a field in. Now, for the regions that you guys are in, you do need to check your special provisions for applicability, because there are statements in some of the special provisions that state a crop must be grown and insured on the acreage at least one of the 4 previous years to be eligible to receive a prevent plant payment. We don't have a list of counties. You basically have to, Tom, I'm not sure if you have a listing of these counties for your customers where this language does apply, but it is something to make sure to check. We don't want to assume you're going to be eligible for a prevent plant payment if you haven't met these requirements in those applicable counties. There are rules for receiving a prevent plant payment for certain acres. We do have a 20-20 rule. The 20-20 rule is that the acreage must consist of at least 20 acres or 20% of the insurable crop. If we do not have the 20-20 rule met on the particular acreage in a unit, then even though you have eligible acres, we're not allowed to pay an indemnity for prevent plant. In those situations, those acres would get removed from the policy as being insured, changed over to being uninsured or uninsurable, and the premiums would not be charged. If the insured has PP on a first crop and a second crop was planted to the same field, unless you have double cropping requirements, this is going to result in a limited 35% payment on the first crop for the prevent plant. If the acreage is used for conservation purposes, it would not be eligible because it's already in a conservation program, therefore not available for planting. The fallow situation, I'm not sure, is something that's going to impact your area. Also, if I don't know if anyone has a processor contract, but you are limited if you do have a processor contract for your crop to the prevent plant to the number of acres listed on that contract. We cannot exceed the acres from the contract for prevent plant payment. We also have situations the situation of exceeding the number of eligible acres. However, if we do exceed the eligible acres by crop, the company does look for alternative crops within the insured's policies to use to prevent plant payments off of. If you do not have proof of inputs, that can also limit you for receiving a prevent plant payment. And also, if you have a crop type or variety that you did not plant or receive a PP guarantee on in one of the 4 prior years. The reason for this is we are looking for the highest acres planted in the last 4 years for eligibility for prevent plant, and if we don't have any acres to refer to for that purpose, we don't have anything to determine eligibility for paying a prevent plant claim. Your unit structure does impact the 2020 rule we mentioned. So here is an illustration for you. If your insured has basic units, that's the top example. When we have 3 different basic units and there's insurable acres of, in the first example is 404.2, and the prevent plant acres was 16.6, the 2020 rule was not met. We have only, we do not have that. Quick way to figure this out is anytime you have 100 or more acres, 20% of 100 is 20. So the answer will always need to be 20 when we've exceeded 100 acres of that are insurable in the unit. For the second column, the entire 14.6 acres was prevented, so yes, they do qualify. And on the last one, they do not qualify because it is not meeting the 2020 rule. Now these are now going down to the next one when we're looking at optional units. There's some examples here as well to show you on an optional unit level whether or not the insured met the 2020 rule. Now for an enterprise unit, we are looking at the entire crop. So with an enterprise unit, it is usually a little bit easier to meet the 2020 rule. We have 1,051 acres. They were prevented from, as long as you were prevented from planting at least 20 acres within that crop, you will meet the 2020 rule. If you're in an area that you can have the EP for irrigated or non-irrigated crops, those are met separately by crop as well, so just keep that in mind. Also, I do want to point out, for those of you who are insuring using an enterprise unit policy, if you do have a situation where you have prevent plant acres for the current year, there is a possibility you could not qualify for the enterprise unit discount for the current year. So in this illustration here, we have acres. We have over 100 acres planted, so we need 20 acres to be planted in at least 2 different locations, which we do not have because in section 29, those are prevent plant acres. We only have 15 acres planted in section 15. So for this particular situation, we do not meet the enterprise unit qualification. If you have an EU policy and that having that discount is important to you for your current year policy, this may be something else that you want to consider when deciding whether or not if you a field to plant to make sure you do qualify for EU. Does anyone have any questions at this time?
Janice, we haven't had any submitted, but I know Tom mentioned he has several sitting in a conference room, so if any of those individuals have any questions at all, now would be a great time for them to ask. If Tom's able to get them closer to a telephone maybe.
I'm actually in a separate room from them, but we do have some staff members in with them, so I don't know if they have any questions or not, but they can let us know if they do.
Perfect. That works. In that case, Janice, I don't have any for you at this time.
Okay, I will move forward if somebody does come up with one. If you just want to let me know, Jody, we can pause and address that unless it's getting to, if that's the way you want to go. Okay?
Sounds good to me. Thank you.
Thank you. So now we have to talk about determining your eligible acres for prevent plant. The eligible acres are the acres that we can pay for a particular crop for on a prevent plant claim situation. So the maximum eligible acres for a crop without processing contracts. If you do have a processing contract, do ask Tom for additional information, and I'll provide that for you. At this point, I did not have anyone that I was aware of that had a contract for their grain. So the maximum eligible acres are acres that have been planted in the county in any one or more of the 4 most recent crop years. So we look back for 4 crop years, and we're going to take the maximum number of acres that you produced for the last 4 years for that particular crop to determine your eligible acres to be paid on prevent plant. We do not include reported PP acreage that was planted to a second crop unless you meet double cropping requirements. So if you decide to take the reduced prevent plant payment, the 35% payment, to be able to plant another crop, those PP acres for that particular crop, those prevented acres from that crop, do not get counted into determining eligible acres for subsequent crop years. If you have a base, or what I like to call a buy-up policy, and the high-risk alternate coverage endorsement policy, each policy calculates its own eligible acreage and is used accordingly between the two. The same thing applies if you have a high-risk land exclusion and have a CAT policy along with your buy-up policy. The eligible acres for CAT will stand separately from your eligible acres for your buy-up policy or your policy at a higher level than CAT. One of the questions I have is, I have added land this year. How do I know what my added land factor is? We do have a report that Tom can provide to you for your particular farm that will indicate your added land factors that will help you to know what those are, to get the numbers. There's a couple other reports that are available through Diversified that Tom also can provide to you if you would like to have those, and I've got some information on those coming up as well. Basically, though, for the added land increase to eligible acres, there's a few requirements. One of them is that the insured, you, must notify Tom so he can tell us, Diversified Crop Insurance is the AIP or approved insurance provider, within 10 days of acquiring the acreage. So if you decide to, if you have leased land or after the sales closing date, you've leased land, inherited some land, however you received that land, you cash rented it, within 10 days of acquiring it, you do need to let us know, let Tom, so he can let us know that you do have an increase in your land. Added land has to be more cropland than was insured last year, not what you had 2 years ago. So it's important. We've had this situation come up. We are looking at a comparison between 17 and 18. Preventive planting is not provided on any acreage if a cause of loss is already in existence on that land. So in other words, as much as I've thought this would be something, a way for me to get a claim is I could go out and rent some flooded ground and say I'm not planting corn. Well, they can't do that. It has to have been it has to be plantable when it is acquired for you to have a prevent plant situation for that acreage for the current year. As I said, it could be acreage that's leased or purchased. You pull it out of CRP. It could be something from an inheritance, gifted acreage, etc. But again, reminding you it must be acquired in time to plant for the current crop year using the good farming practices. So here's an example of how the increase is done to your eligible acres. Now this is based on how many crops are on your policy. So for example, here I've just listed corn, soybeans, and spring wheat. It could be that you only have corn and soybeans. So what we do is we create a factor. The factor is determined by taking the 18 acres divided by the 17 acres. So in my example, the insured had 1,400 acres for 2018 and 900 in 2017. You do that division and come up with a number of 1.556. This is rounded to 3 decimal points. The RMA is very particular about telling us how many decimal points something goes to. We then are going to take that factor times the acreage that's in of each crop that was the eligible prevent plant acres. So we're going to take the eligible acres for the corn times the factor, the soybeans, and the spring wheat. And this is proportionally dividing that information out between the different crops listed. One thing we do not do, and I want to make sure that everyone understands this, is you cannot say I added 900 acres and I want them all to go to corn. The RMA does not allow that. The acres that are added are spread not equally, but spread based on the number of acres to the different, or based on the factor to the different existing crops on that policy. For irrigated eligible acres, there are some additional factors. So we're going to take the current year's irrigated acreage divided by the prior years to get the factor. If there were no prior irrigated acres, then the eligible acres are limited to the lesser of the number of eligible non-irrigated acres of the crop, or we're going to determine how many acres have an adequate irrigation facility to use for that reference. For the unavoidable uninsurable fire or third-party damage procedures, which are fairly new, the eligible acres, planted acreage not included in the APH database that was due to the UUF for the third party in any of the 4 years is included in your PP eligibility. So if you do have a situation where a fire was caused by something that you couldn't avoid, a person, for example, throwing a cigarette butt out in your field and it catches on fire, or third-party damage, chemical sprays from drifting over from another farmer's land, and you decide to not include that in your database, don't worry, the acres from that field still do get counted towards your eligible acreage determinations. If we have acreage that does not qualify for prevent plant, that is always removed. Well, it says here removed from the acreage report. It's physically not removed anymore. Now we do reclassify it as uninsurable acreage, and no premium would be due. And of course, we would no longer be, there would be no chance for an indemnity on that because it didn't meet the requirements. However, if we do have another crop on the policy that has remaining eligible acres, there is a chance that we can use that other crop to pay your prevent plant payment for your particular field that was prevented. Do we have any questions?
I do not have any questions coming through.
Okay. Thank you, Jody. The planted acreage reduces eligible acres. I'm just going to point out here quickly, if you, for example, have a maximum eligible acres on your corn of 500 acres. If for the current year on that policy, you were to plant 250 acres of corn, we take that 250 acres of corn that was planted and we will adjust that from the eligible acres, leaving you a remainder of 250 prevent plant eligible acres for your policy. And I'm going to skip that one. And what do we do if the insured plants another crop in the field or plants a cover crop? What if I handed a PP claim but end up planting beans to those acres? Well, we're going to talk about what happens there. For example, the insured plants another crop in the field. If you do plant another crop, even when uninsurable, it does reduce the PP eligible acres. If you plant a crop on the prevented plant acreage before the end of the late plant period of the prevented plant crop, you will have no PP indemnity. So for example, the corn crop, the end of the late plant period is, I believe, was June 25th. You cannot plant another crop to that field prior to June 26th if you want to obtain a prevent plant payment. On the 26th or later, you could go ahead and plant soybeans, for example. Now, when you plant the soybeans, you're going to now have a 35% reduced prevent plant claim. If the soybeans were planted prior to on or before June 25th during that late plant period, then we would have no prevent plant claim situation for those particular acres. Only planted acres on the same crop as the eligible PP acres cause the reduction. A planted crop type or practice may have a premium rate, but the acreage is planted on may be uninsurable. Oops, I apologize, I scrolled the wrong button. The planted crop must meet all definitions and descriptions of the crop found in the policy and special provisions, as well as the requirements of the insured crop section of the policy and any applicable portions of the special provisions. If the crop is uninsurable, no premium is provided. A planted crop type, or crop practice may have a premium rate provided in the actuarial documents, but the acreage it is planted on may be uninsurable under the terms of the conditions necessary for the premium rate to apply. If that's the case, the acres are still considered planted even though they're uninsurable and will reduce eligible PP acres for the crop. So an example. Acreage of corn planted after the late plant period is normally uninsurable unless the reason the corn was planted after the late plant period was due to an insured cause that prevented the corn from being planted during the late plant period. Even though the planted corn does not meet insurability requirements, eligible PP corn acres will be reduced by the number of acres of corn that were planted. Another example is the silage variety of corn planted for silage in a corn for grain only county is uninsurable unless you have a written agreement. There is no premium rate provided for this crop in the actuarials. It is not considered the same crop as corn for grain, for which a premium rate is provided, and it will not reduce eligible PP corn for grain acres in this situation because we are planting a variety that is not insurable in that county. It doesn't impact. It would have to be in this situation since it's uninsurable, there's no premium rates. We're not going to count silage against grain corn. As far as cover crops, they need to be generally recognized by agricultural experts. They cannot be enrolled in the NAP program, which is FSA's Non-Insured Crop Disaster Assistance Program. If hayed or grazed prior to November 1st, we will reduce the PP payment to 65%, or as we talked about, the 35% reduction. If it is planted or harvested for grain or seed, then we would use first crop, second crop rules for this particular situation. If the cover crop is covered by NAP, it is considered a second crop, and the initial indemnity is also reduced in this situation by the 35%. We do have a chart here guiding you on what to do or what will happen if you hay or graze your cover crop. So in this particular situation, we have a cover crop planted before the final plant date of the prevented plant crop. If it is hayed or grazed before the late plant period, then we pay the prevent plant claim at 100%. If it's grazed on or before, if it's harvested before November 1, there is no payment made. If it's hayed or grazed after the late plant period but before November 1st, there is a 35% reduction in the prevent plant claim, as long as the crop claimed as a cover crop is not the prevented crop. So you can't plant a cover crop of corn in a cornfield, and in that situation then we do not get a PP payment because you planted the prevented crop. During the late plant period, if the cover crop is planted during the late plant period of the prevented crop, if it is harvested before November 1 or harvested after November 1st, anytime it's harvested, you will not get any prevent plant claim because you have received an economical benefit from that particular crop. If it's hayed on or after November 1st or grazed on or after November 1st, there is 100% PP payment made. If it's hayed before or grazed before November 1, there is no prevent plant payment. And then if the cover crop is planted after the late plant period for the PP crop, hayed or grazed before November 1, or is the 35% payment. If it's harvested before November 1, you could get a 35% as long as it's not the same crop that was prevented. If it's harvested on or after November 1, again, we could receive 35% of the payment if it's a different crop. If it is hayed on or after November 1 or grazed on or after November 1, the insured receives the 100% prevent plant payment. So this chart is here. If you would like a copy of this chart, we can get a printout of this particular slide for you. Just let Tom know and we can print you a copy so you have this as a reference. And the question we have here is, what if I don't plant a cover crop? Tom, would you like to address this?
Yes, Janice. Obviously, we have rules for the crop insurance policy, but also there is other rules too within the, I would say, refer to your local FSA office about, obviously there is a compliance in the state of Minnesota that there will need to be a cover crop planted. Plus, the state of Minnesota has a written policy on cover crops, and you can pick up this policy or sheet over at your local FSA offices, and it also includes recommended seeding rate and things like that. So it's a really nice document. Just so you know, the folks in Iowa, that could be different. Okay, so each state could have different cover crop compliance rules.
Great, that's wonderful advice for your customers, Tom. Does anyone have any questions about the cover crop procedures that I just covered, or anything else that we've gone over so far?
Hey Janice, it's Jody, and I do not have any questions that have come through on our end.
Okay.
Just as a reminder, though, because it is a different system than most people are used to, If this is your first time on the webinar, you'll need to use that dashboard feature to ask a question. So when you pull up your dashboard, look for the hand. Looks like it's giving you a high five. If you click on that, it lets me know you have a question. Or you can type one into the question text box. Those are both ways you can get questions to Janice today.
Thank you, Jody. So the next topic I want to talk to is about rolling or borrowing prevent plant acres to make payments. So we could have a situation where you do not have enough eligible acres of a particular crop that you've claimed to prevent plant on. In these scenarios, what the company will do, and this is an RMA requirement, this isn't unique to Diversified, what we will do is we will reference another crop that you have insured for to determine if we can roll 2 eligible acres from that crop. So when we do this, we move to the crop with the next closest payment, whether or not it is of a higher value or not. So in the situation, let's just say we have soybeans that are insured and turned in as prevent plant. You do not have enough prevent plant acres for your soybeans, but you do have some prevent plant eligible acres left on corn. In this situation, we would use some of the corn acres. However, since corn is valued at a higher rate, we would have to hold the payment at the soybean level to make the payment. However, you're going to get a payment because of the fact that we got to use the corn's eligible acres. In the reverse situation, if we had a corn prevent plant claim and you did not have enough eligible prevent plant acres for corn to pay the entire claim amount, claimed acres, we would roll the acres we could to unused prevent plant acres of soybeans. But in this situation, the RMA requires us to reduce the payment to the soybean level. So think of it this way: if you're moving to a crop that has a higher value, the payment will be held at the prevented planted crop's actual payment. If we roll to a crop of a lower value, we are going to pay the crop at the lower valued crop we are using. The administrative fees will not be charged for a crop that is rolled to, if that is the only acres indicated are for that prevent plant situation. So if you have no soybeans planted for the current crop year, for example, and we have to use pardon me, we have to use soybean acres to help pay a corn prevent plant claim, you will not be charged an administrative fee for the soybeans because you truly did not have your own insured soybean acres, such as that were planted or prevented from being planted. We're just using those acres for the corn side. And this is basically just saying again how I was just explaining the PP payment and premium when other crops eligible acres are used will be based on the crop prevented from being planted if we roll it to one with a higher payment, or the crop rolled to if the insured crop with remaining eligible acres is a lower PP payment. So you're not going to get charged for corn premium if we're paying your PP payment based on a soybean level. You'll get billed at the soybean level. The payment may or may not be made from a crop eligibility that is in the same physical location as the acreage that was prevented from being planted. So an example is land upon which the crop was prevented from being planted may be located in legal section 12, and the crop and unit for which the PP payment is most similar and for the PP payment will be based on could be in legal section 9. There is not a requirement that physical location is the same. Again, we're basing it on where we can get the closest payment for you, the customer, when we either roll or borrow acres. we also do not have to have the same amount of acres into the unit we're borrowing. We're just looking for the dollar value there. So you could have a claim for 200 acres of PP corn when you do not have the remaining eligible acres to pay that. We don't have to have 200 acres of remaining eligible soybean. The insured does not have 200 acres of remaining eligible soybean PP acres. Soybean unit 11OU composed of 100 acres would result to the closest PP payment. So we're still going to use a unit that has less acres in it as long as we have the eligible soybean PP acres to use on the policy. The unit itself may not have that exact number of acres we need. But that doesn't prevent us from doing this. I'm going to skip past the questions unless Jody interrupt me if we have any. I don't think we do. The next topic is the first crop and second crop and its relationship to prevented planting. So what if a second crop is planted on the same acreage for harvest in the same crop year? Well, we have to look at this. One thing we have to do is this is for when double cropping does not apply. If you are in a situation where you do have some double cropping history, this is handled differently. Again, I'm going to refer this back to Tom for if you have any questions about double cropping history, let him know and we will be glad to discuss those with you. If you are planting a second crop, and this is making the assumption that you have insurance for the other crop. So I was prevented from planting corn. I have soybeans on my policy as well. You would decide to plant soybeans as a second crop and take the reduced prevent plant payment. So you will pay the full premium for your second crop. These are normal first crop, second crop procedures. If there is an insurable loss on the second crop, you would receive the full amount of indemnity due for that second crop, the soybeans. A second insured crop cannot be planted on or before the final plant date or during the late plant period of the first insured crop to receive a prevent plant payment. Okay? The first insured crop you may collect. You choose to collect your 35% reduced prevent plant payment. Again, only if the second crop is not planted during is planted after the end of the final plant date and after the late plant period if there is one for your region. The insured you will pay the 35% premium for the first insured crop in this situation. So here is an example. First crop prevent plant corn has 200 acres in Unit 1-1. Corn crop planted after the late planting period. Since the crop is planted after the late plant period, you can select insure or not to insure this crop. However, it is not considered prevent plant because it is now considered a late planted crop because it is the same crop as it was turned in for prevent plant. The corn crop was put in on corn prevent plant acres, so therefore no prevent plant payment, and then you can decide to insure or not. Again, you must have been prevented from planting during the entire late plant period to insure the crop for this particular field. The next example is the first crop PP corn, 180 acres in Unit 1-2. A second crop of soybeans was planted on 80 of those acres. 100% PP payment on the 100 acres of PP corn because there's that particular acreage did not have another crop planted on it. A 35% PP payment on the 80 acres of PP corn that was planted to the second crop of soybeans. The choice to insure that second crop of soybeans would be up to the insured. First crop, second crop, our first, the number 3 example, first crop is prevent plant corn at 80 acres in Unit 2-1. We have no second crop planted. The 40 acres have a cover crop planted after the late plant period and grazed from August through September, the corn will receive 100% PP payment on the 40 acres that did not have a cover crop planted to it. The other 48 acres will receive a 35% PP payment reduction because the cover crop was grazed prior to November 1st. One more example here is this is when part of a field is planted to another crop. So the portion of the first insured crop PP acreage is planted to a second crop. For the Unit 11 corn, 90 acres will receive the 100% PP payment. The 10 acres that are planted to soybeans will receive the 35% reduced PP payment because we have a situation where two different crops were claimed in the same year. Do we have any questions?
No, ma'am, we do not.
Okay, thank you. Preventive planning on the acreage report. This is important. I'm not going to go to a lot of information particularly about this, but the one thing I do want to point out is you must report information for prevent plant acres on the acreage report. If you do fail to do so, we cannot revise those. Even if it is before the acreage reporting date, once it's been submitted. Just filling out the act of filling out a notice of loss, even though you are listing the acreage on there, does not meet the total RMA requirements for prevent plant situations. We must have a notice of loss turned in timely, and we must also have those prevent plant acreage with the correct crop listed on the acreage report that is turned into the company by the signed by the acreage reporting date. Be very careful you have the correct crop listed. The RMA does not allow to change the crop that is listed. So make sure that that is accurate. You also on the acreage report need to identify the insurable, uninsurable, and ineligible PP acreage. So if you know, for example, that you don't meet the 2020 requirement, you're going to report that as an eligible PP acreage. If you have, then you can also have it an insurable. If you're not sure if prevent plant acreage does meet the requirements, always report everything as an insurable practice. We at the company can alter the insurability type to change it to being uninsurable if it doesn't meet the requirement. It's better to err on the side of caution and call it insured, because if it's not called insured, it's harder to switch it back. If it's called ineligible PP acres on the report, it's harder to turn it back into insurable than vice versa. For production reporting, one thing, there is a situation where a prevent plant can impact your production database, and that's when the insured has elected to take the reduced PP payment and do the 35%. In this situation, the prevent plant acres do get included on the in the production report and will be part of the database. So an example is 100 acres of prevent plant and 200 acres planted within the same unit. Only the 200 planted acres will be reported to the APH record for the unit. This is if we have a mixture of both planted and prevent plant units. When we have, if there's special procedures for that production that your agent is aware of and can explain to you if you get into this situation. We also have a situation where if we have a limited to 35%, we do include this in the production database as well. You will get a yield equal to 60% of the approved yield for the prevent plant acres, and this will be included in your database and continue on to impact your policy. So this is something to be aware of if you do make the election to plant a second crop that you on the same acreage that were prevented. Questions? Okay. So loss notification. The insured, must submit a claim declaring loss. Failure to timely submit the claim could mean that no indemnity will be due. So for Prevent Plant, you would turn in the loss within 72 hours after the final plant date if you do not intend to plant during the late plant period. Or you can turn in a notice of PP loss, would be the final plant date plus the late plant period, if applicable, plus 3 days. So the late plant period ends on June 25th for corn. So you'd have until the 28th of June to turn in a Prevent Plant notice if you wanted to try during the entire late plant period. The other time you can turn it is if you decide you don't want to continue to try to plant during the late plant period. Once you've made that decision, you have 72 hours after that point to turn in the notice of loss with Tom and his staff. A question I have related to claims is, can PP payments be used to pay premium? The answer is yes, even if it's on another policy. So for example, if the premium has already been billed, and this is one of the stipulations, a premium has been billed on a policy, the spring corn PP claim is settled and paid on July 2nd. The fall wheat policy was billed on June 30th. Since we already have premium billed, we will pull the premium for the fall policy from the spring corn Prevent Plant payment. Now there is a choice for you, the insured, and when an adjuster comes out with paperwork, they will give you this information to select. You need to be careful to make the selection based on what you desire. Is you can mark yes to authorize us to pull unbilled premium for any of your policies from your indemnity payment, from your Prevent Plant payment. If you want to receive your full Prevent Plant payment and none of your policies have been billed yet, don't mark no that you don't give us permission to do that. The last little bit I have here is some worksheets and reports. These are some items that Tom has access to you to get you upon request. This is a worksheet that can help walk through a Prevent Plant scenario. So you can compare the difference between getting your payment at a full or reduced payment or on this particular form. For your eligible PP acres, we have a Prevent Plant worksheet available at Diversified. This is also another form that Tom can access for you. If you look here, you can see this example is a couple years old, but it works the same way. It's showing the most 4 recent years, and it's picking the greatest acreage. So for this particular crop of corn, this producer has 323 eligible Prevent Plant acres for the current crop year. And then for the soybean crop, they have 318.6 eligible acres for the current crop year. There is the math as well underneath the net eligible acres for the added land factor. Again, you have to do some of that math there for the increase, but you can use this worksheet as a place to write and determine what your added land factor in increased acres for the current year are for Prevent Plant. For me to make some decisions, I need to know what my PP payment would be by crop. How do I know this number? This is yet another report you can get from Diversified that Tom can help you with. This particular example here is showing a line-by-line PP liability so you can see what your options are. Again, this is something that we can print off for your particular policies. Any questions?
We do not have any questions coming through.
Okay, thank you. Well, this is the end of my presentation. I'd like to thank you for attending. If you come up with some questions that you have, please feel to reach out to me with those. Or reach out to Tom. He will reach out to me, and I will work with Brad to get those answered for you. Tom, would you have anything you would like to say in closing?
Thank you, Janice, for doing this presentation. A lot of information. And actually, we shortened it up so,
Yes.
from the previous one. So there's a lot to preventive planting, and I want to say thank you to everybody that attended. And please don't hesitate to give me a call if you have any questions, or if any of you need those reports, because I do have them already and available for anybody that would want those reports.
And we did record this presentation. Tom, we will reach out. I will get a hold of you for delivery options. It's a very large file. We'll probably have to do something like a Dropbox type situation for this, for any of your customers or staff that would like a copy of this.
Yes, and we will be putting that into our website at americanainsurance.com.
Wonderful. Well, if no one has...
I want to say thank you, yes.
Yes, yes, and thank you to all of the farmers who took time out of their busy schedules to attend. I know this time of year it's not easy to stop what you're doing. Even if the weather isn't cooperating, there's always plenty of items that need to be attended to, and I appreciate the time you took to be with us today.
Hey, Janice, can I jump in here just real quick? It's Brad.
Of course, Brad. Your knowledge is always very welcome.
Hey, I just want to reiterate one of those last points to you. From the adjusting side, it is very important when you make that decision that you're going to be prevented to get your notice of loss in, for the adjuster to come out and visit with you. We do need to document your peril, which means we need to be able to see it. So it's very, very important. Once you think you're going to be prevented, please get your notice in. The adjuster will call you, will come out, will take a quick field inspection to get the peril. That's also a great time to discuss what your plan is for that acreage for the rest of the year with the adjuster. And they can visit with you one-on-one about your specific situation, whether you're determined to go to a crop if it dries out, if you're thinking of a cover crop or hay crop. It's a great time to ask some one-on-one questions about your particular situation. But the critical thing is as a company, we do need to make sure we get your peril identified and documented. Thank you.
Thank you, Brad. Very good advice. Yes, yes. And that being said, Tom, do you want to close out?
I just want to say thank you, everybody. Hope it dries out here. That's all I want. I would love to see some sun, everybody. Thank you.
All right. Thank you all for attending.